A few key things in the revenues by segment is that Netflix has grown its revenues over four times as much since 2011. The DVD segment is experiencing a little bit of decline, but the other two streaming segments have been increasing steadily. When we analyze the contribution margin by segment, we realize that the international group is struggling some, but that's mainly due to the high cost of acquisition of the content library and due to expansion into more international countries. When we look at the consolidated revenues for Netflix, we see that they're increasing and that they've experienced growth in the last 3 years, but so have the competitors. So it's important to realize that the industry as a whole is growing and that they still have an opportunity to keep growing and keep expanding with their international expansion. When we're comparing Netflix to Redbox's operating income, we can tell that Netflix is very unstable overall compared to Netflix. A lot of that instability comes from their cost of expansion. Some of their costs are going to be one-time costs that hit directly in each year. Other costs are going to be recurring costs, like their contract costs to get the content to the customers. But those are what's causing the instability within their operating income, where you can tell Redbox has had a fairly steady and increasing operating income per year. When we take a look at the market capitalization analysis, we need to remember that this is companies as a whole. It's not broke out by segments, so you're not comparing apples to apples like necessarily. When you look at Netflix, it looks like they're really struggling compared to Amazon. However, when you look at Amazon, you got to think of all of their different segments with Amazon Web Services and their Prime, and all their other segments that they have as a business. So the diversity allows them to capture a lot more of the market. When you look at Outer Wall or Redbox, you got to notice that they're struggling a little bit as well. They're not doing as well as Netflix even. And we also notice that there's only information up to 2012. That's because their 2013 financial information has not been released yet. Return on stockholders' equity had a sharp decline in 2012. That's primarily due to the decline that it took in net income, once again relating to the cost of expansion and the cost of their acquisition that they had for their content library. It was a very direct impact that they took, but they're really expanding the company as a whole. So overall, it's not a real good measure because it's not truly capturing all the expansion that's going on. Earnings per share once again shows a sharp decline in 2012. That's due to that content acquisition that they had. So overall, 2012 was a rough year for Netflix. And we can tell, though, that overall Netflix is doing better than their competitor, Redbox. It'll be interesting to see how Redbox turns out for 2013 financial information. So as we look to the debt to equity ratio, we notice that there's a little bit of decline in 2013, which isn't a bad thing at all. This is how much debt they use to finance their operation compared to how much equity they have as a corporation in order to offset that debt. So you want to kind of keep it fairly consistent. Right now they have a lot more debt, which once again, that's a lot of contracts and stuff for their content that they have to get to the customers. They have huge contract dollar amounts and liabilities associated with that, and that's where a lot of your debt comes from. So shifting gears a little bit to look more at the asset management effectiveness of Netflix, we notice that a majority of the assets held within the content library for Netflix are held within the content library for Netflix. In 2012, 72.4% of their current and non-current assets consisted of the content library. That decreased a little bit to 70% within 2013, but that is a huge portion of their assets, their total assets. And when you look at that compared to like their total operational structure and like their buildings and all that kind of thing, it's huge to recognize that that is what runs Netflix, is their content library. And that's why we keep stressing that this whole acquisition of more content is huge for Netflix. And without that, they can't really keep going as a company if they're not going to keep expanding that content library. So this graph shows their total content library that Netflix has. In 2009 through 2011, you can tell that it's not broke out by segment. That's because Netflix didn't think it was important to break that out by segment until in the 2012 financial statements. That year they broke it out, and you can really tell that the DVDs don't account for a whole lot of their total content. A lot of it's their streaming and their contracts that they have to stream those movies and the TV shows. It's important also to realize that both the domestic segment and the international streaming segment are both increasing. In looking at the total asset turnover ratio, it's a measure of how efficiently Netflix is using its total average assets to generate sales. So when you have 1.6 in 2011, that means there's 1.6 times as much sales generated as what they hold as in total assets. You can tell it's decreasing. That's once again due to acquisition of more content library. When you look at 2013, it is below 1, which means that it's generating less sales than what it has to assets, which isn't really a great thing. But when you think about the expansion that they're doing and internationalizing and stuff, this shows that Netflix is really trying to expand that content library for a greater reach. And a lot of those are upfront costs, so you won't see the sales hit until later on in a different year. In looking at the working capital and the current ratio, we notice that working capital has increased greatly, which is good because it can open up Netflix's opportunity to work on new projects and continue expansion because it has more cash available or current assets available to work on that kind of thing. The current ratio is positive or above 1, so that means there's more assets than what they have current liabilities, which is a good thing because they need those current assets to be able to pay off their current liabilities. For the return on total assets, you can tell that Netflix has kind of taken a hit in this area. Once again, that's due to the content library expansion that they had. It really kind of throws off what this equation actually looks like or what this analysis actually shows, because their earnings have remained, well, fairly constant. They did go down some in 2012, but they're increasing again. And you can tell that in this graph, but the assets that they have acquired have also had a great impact on the outcome of this analysis. So as a wrap up, the key thing to note is that with the content acquisition that they're doing, it's really affecting a lot of their overall analysis within the company and a lot of their ratios that investors use to analyze how well the company is doing. Next, we're going to shift gears and look at the 3 strategic issues that Netflix faces. The first one that we're going to discuss is internet reliability. Netflix is very reliant on internet service providers to provide uninterrupted streaming to the customers. If one of them fails, then that's a major downtime for Netflix. So right now they currently have a partnership with Comcast to provide uninterrupted streaming. About 30% of Comcast total bandwidth is provided to Netflix customers, and Netflix has paid for basically the bandwidth that is associated with their website. Another couple of internet service providers, Verizon and AT&T, have purposely tried to block sites and slow down traffic to sites such as Netflix because it takes such a great amount of their bandwidth to provide access to those sites. So right now Netflix is fighting a battle of net neutrality, which is a tier of the prices. So the greater amount of bandwidth that's used, the higher price that you would pay. This wouldn't be good for Netflix customers because they'd have to pay a higher price for their bandwidth usage. Internet service providers are already raising their prices, and Netflix customers are price sensitive to both the internet price and Netflix's prices. So it could create loss in customers if internet prices raise much more or if Netflix would raise their prices. There's also an increasing price for bandwidth, and that's very critical to Netflix's services. There's also a high demand for the internet, and this gives the internet service provider a lot of the power to charge higher prices in this situation. Internet service providers are already increasing their prices, and customers are really price sensitive to both the internet price and the prices that Netflix charges. So if the price is increasing, more and more customers are just going to decide that Netflix isn't worth it because of the internet cost as well associated with what the customers are paying. And there's also an increase for bandwidth. So when increase in price for bandwidth. So like if Netflix decides to do more partnerships, strategic partnerships like they did with Comcast, the sooner they can do those, the better, because that'll lock into a price and they won't have to pay as much to basically buy that bandwidth so the customers can receive unlimited streaming. There's also a high demand for internet, which gives the internet service provider the power to charge higher prices. Other factors to consider with the internet reliability is that Netflix is expanding into less developed areas and countries, and some of these areas the government has a very high control over the internet. So what they're allowed to provide to customers will change in these areas as well, depending upon what the government will allow. And also technology development is a lot different within those areas as well. And some of those differences will determine what can be provided to customers. The second strategic issue that Netflix faces is that they have a high cost of content. So they're trying to expand into new geographical areas, and for like one of the ways to expand is to expand both their DVD and library acquisition and their internet streaming. In 2013, they spent 17.7 million on DVD content and 13.9 million on streaming property and equipment in order to stream into additional areas. But some of the other reasons why they have to expand their content when they expand into new geographical areas is because the culture is different and the languages are different in some areas. So they have to provide services that will cover those individual needs within the area that they're wanting to expand into. And they also have to differentiate from their competitors within that area as well. So as with most expansions, it's very risky to enter into a new market, and a lot of their contract costs are upfront costs that are provided through multiple years, but the main cost hits, or the big chunk of the cost hits immediately. So some of these areas they haven't even expanded into yet, but they're having huge expenses associated with that expansion already being incurred. And they're also really reliant on relationships with major movie and TV studios in order to provide the services. So if they don't have a good relationship with, let's say, Disney or Sony, then they can't provide content to the customers that is as cheap as what it could be. Another thing is that the financial ratios for Netflix aren't necessarily attractive to investors, and they're not accurate due to some of the off-balance sheet portions of the content library, and also their major asset acquisitions for content library. It really affects how the financial ratios appear. They also have a very high increasing cost of their content licenses. So looking into the future a little bit for their streaming obligations, in 2014, with just the content library that they have right now, they're expected to pay $2.9 billion in licensing fees to continue to provide those services. And in 2015 to 2017, they're expected to pay another $3.2 billion to continue to provide services and content to the customers. A lot of this is due to expanding the content library, but like I said, it does not include any of the future expansions that they will do. The third strategic issue is created when Netflix relies on Amazon Web Services to provide the data backup and cloud computing for them. This creates a really unique infrastructure because it's a competitor that they're allowing to do their data backup and their cloud computing, and it houses a lot of their mission critical services in content library, so that's completely open for Amazon to see. It also creates a strategic balance issue because if they don't maintain that strategic balance, then Netflix is going to be in a world of hurt because that to have that cloud computing and that data backup and have that online and working is critical to what Netflix is trying to provide for customers. It also hinders the opportunity for expansion because it gets really costly due to the need for additional backup capabilities and computing abilities, because they have to expand that in order to provide the space that's needed in order to back up additional expansion. It's also a very critical time when Amazon Cloud Computing Services goes down, because that leaves Netflix down. So twice alone in December of 2013, Amazon Cloud Computing Services was down, and that was lost revenues for Netflix. Another thing to consider is the privacy information. The customer information is out there on the backup and the cloud computing, so that's information right directly available to the competitor if they look at it. And another thing is the business processes are that way too. It's all backed up and out there on the cloud computing, and without those services being kept secret or being kept confidential, that opens them up to a lot of risk.